Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, cut your taxes, and have a beautiful retirement. What could be better than that? I am one of your co-hosts, Ben Barzideh. I have my co-host, Matt Nadeau here.
Hey, everybody.
We are both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located right here in Barrington and serving the greater Chicagoland area. And of course, our fiduciary obligation to put our clients' interests first is the tenet of our company philosophy. And as an independent firm, we truly have the freedom to focus solely on your interests, not some corporations.
I'm sick of those corporations, Ben.
That's
sick of them. And of course, we've got all of our wonderful clients who are out there listening to us each and every week. We appreciate the trust that you place in us, and we love every one of you. And of course, I think we have a great show as usual today. So there's going to be a few key topics we want to touch on. So first, US, China, it's like that old saying, enemies can't get along. We're always fighting about something. So we're going to talk about something special that you may not have heard of that they're fighting over. Then we're going to talk a little bit about gold and silver. It's on fire still. There doesn't look like there's an end in sight. And we're going to talk about some economists from Yale that are warning us that this AI bubble is starting to look a lot like the dot-com bubble. And then later in the show, we're going to hit a very important tax strategy called tax gain harvesting. And that's how you can potentially turn taxable money into tax-free money, tax-free. It's great.
Amazing, right?
Yeah,
we're not
I
kidding.
love that. You don't want to
wait
miss
till we
it.
explain it. But before we start, as always, we encourage you to follow us online via our BN Wealth social media pages on Facebook and Instagram. Also, don't forget to subscribe to our weekly economic newsletter that's called the 5-Minute Market Brief. It's informative, it's succinct, easy to read. You can sign up for it on bnwealth.com. And then lastly, please subscribe to our YouTube channel on moneyhourradio.com, where you can view this week's episode along with all the previous ones.
And to all our subscribers out there as well, we love every one of you as well. So thank you.
No doubt.
So, hey, what's this US-China fight over, Ben? I mean, it's a little surprising. It's actually something called rare earth minerals. We also got the semiconductor chips we're fighting over, and of course, soybeans.
Soybeans?
Yeah, hey, you got to get that soy milk, right?
Exactly.
All right. Hey, rare earth minerals, though, that's the big one. That's quickly becoming a major source of trade tension for two reasons. Now, first, they are in extreme high demand as they're needed for the semiconductors and a lot of this next-gen tech that it's necessary for. And second, guess who controls it all? China. They're controlling the majority of these rare earth minerals in the world, and that's really given China some leverage in the trade conflict with the US. So China actually controls somewhere about 70% of the global production, and more importantly, 90% of refining capacity. And given this vulnerability, the US is actively trying to source rare earth materials from more friendly sources.
Yeah, actually, we just signed a deal this week with the Aussies, Australia, our friends down under, for a mineral deal. I think it was like $8 billion or something.
Hey, we'll take it right now. Thanks.
Now, next, turning to semiconductors. So U.S. companies make the most advanced chips that China needs to fuel its AI tech sector. And to help ensure U.S. AI dominance, our government has been restricting U.S. companies from selling those cutting-edge chips to China. And the U.S. is using access to these chips as leverage in this trade conflict. Finally, we go from rare earth minerals and cutting-edge tech to one of the most boring and plentiful commodities in the world, soybeans. They grow it everywhere by my house anyway. I live by the farms. So China has historically been a massive buyer of U.S. soybeans. In fact, in 2024, they bought 985 million bushels of soybeans from the United States, and protecting our farmers is a major priority for the Trump administration.
Yeah, so in response to this various trade threats, China actually dramatically reduced its soybean purchase by 75%. And China imported zero. Not a single soybean came into the US in September. So to recap, the US and the world needs these rare earth minerals for manufacturing, semiconductors, and next gen tech. And China needs the US semiconductors to build out modern AI infrastructure. And the Trump administration needs China to buy more soybeans to protect the domestic farmers. And of course, they're a key constituency group that he wants to keep happy.
So there you have it. Now you know what all the fighting is about. This last trade war.
Can't
issue
we
we're
just all
dealing
get
with.
along, Ben?
No doubt. Gold and silver. Little pullback we're seeing right now, but still on fire. So there was a little pullback this week with gold and silver. But like I said, they are on a tear. We're extremely bullish on gold and silver for the foreseeable future. And you know what? They can't go up every day, right? Got to expect a little bit of profit taking at some point. Actually, maybe I shouldn't say profit taking. So a funny story about that. A few years ago, after a hot streak in the market over a few months, the market was having one of those 2-3 bad days in a row, but nothing too crazy. It was still up a lot for the year. So one of my clients called nervous about the recent losses, and I tried to calm him down. And I said, it's no big deal, just some normal profit taking. And then I'm telling you, he went ballistic and started yelling at me. He said, those are my profits they're taking. That's my money they're taking. So ever since then, I've been using normal and routine pullback instead of profit taking.
It's still profit taking.
But hey, it might be a good entry point.
That's right. That's right. Well, hopefully he calmed down after you explained it. So
He did. He's a really nice guy.
good, good, good. Well, let's talk about this AI potential bubble. And Yale economists are starting to warn, watch out. It's looking eerily similar to the dot-com bubble. And obviously, it's been a parabolic wave of stock hyping announcements recently in AI. Deals include multi-billion-dollar cross investments, mergers. But under the promise of future gains, these deal announcements amount to something far less attractive and actually reminiscent of past bubbles. So things include what we call vendor financing, leveraged debt accumulation, and this circular money flows that are insidious and incestuous. Those words are just too similar. Insidious, incestuous. It could be really hard if like English is your second language or just learning it. So
Or if you have a lisp.
Or-
Just saying, hey, I have a lisp. That's how I know. And those are definitely two hard words for me to say. So,
all right.
all right. So here's what we mean. Two experts from Yale, Jeffrey A. Sunfeld and Stephen Henriquist, explained this tangled web perfectly. Here's what they said in quotes. So let's get this straight. OpenAI is now taking a 10% stake in AMD, while NVIDIA is investing $100 billion into OpenAI, and OpenAI also counts Microsoft as one of its major shareholders. But Microsoft is also a major customer of AI cloud computing company CoreWeave, which is another company in which NVIDIA holds a significantly equity stake in. And by the way, Microsoft accounted for almost 20% of NVIDIA's revenue on an annualized basis as of the last fourth quarter close of 2024.
Do you see how that's all intertwined in like one family of NVIDIA?
No doubt.
And literally, if you go back 3 years ago, OpenAI had just come out and it was like a parlor game. And now, as a Yale Insight said, it's a pillar of the global economy in just 3 short years. And this complicated model of this interdependence and leveraged debt was incredibly common. Guess when? The late 90s, leading up to the peak of the tech bubble. And in fact, Cisco Systems, if you remember, they were a respected company, dominated the network and internet infrastructure. They created this entire subsidy called Cisco Capital to simply just provide financing to all of these companies to then buy Cisco's hardware and software. And then, of course, the fallout when the tech bubble burst was so devastating that even some of the big can't lose stocks like Cisco fell so far that they still haven't climbed back to their previous highs more than 25 years later. So, in fact, the very same Cisco CEO, John Chambers, who navigated the company through the dot-com crash, now sees the same red flags with AI.
No doubt. So, whether AI is a bubble or not, it's definitely too soon to tell. There's a lot of excitement, and we're riding this bullish wave as far as it'll take us. In fact, in a lot of our models, we are currently 100% stock. But we watch our positions every single day. And if the market starts to deteriorate, we will get defensive by actually selling out of the stock market and going into bonds or cash while we wait for things to improve. So, if you're looking to have your money managed like that, please give us a call. You can reach us at bnwealth.com or call our office at 847-780-2980. All right, don't go anywhere, because when we come back from break, we're going to talk about tax gain harvesting.
Welcome back. Thank you for tuning in. This is the Money Hour Radio, a show where we try and help you grow your money, pay less taxes, and of course, have a beautiful retirement. I'm one of your hosts, Matt Nadeau. I have my co-host with me, Ben Barzideh.
Hello, everyone.
And of course, we're both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, which is a comprehensive financial planning firm. And we're located locally right here in Barrington and serving the greater Chicagoland area.
And we have a simple motto. It's do great work, have fun, and give back. And we value supporting churches or charitable organizations that are helping our local community and beyond. Therefore, we are so proud to introduce BN Giving, the philanthropic arm of our company. And we don't just talk about purpose, we actually invest in your purpose with you.
And if you become one of our clients, and let's say you're a faithful tither or a regular giver to charity, as long as it's an official 501c3 organization, just let us know. And what we'll do is we'll actually match your donation up to 10% of the management fee you pay us each year. And it's more than just a program to us. This is a movement that we're pioneering that's unique to our firm. And it's one that celebrates a culture of giving and a more altruistic way of doing business. You know, with us, by partnering with like-minded clients who share our same vision for generosity, we aim to align our values with yours, and it helps your generosity go even that much further. So as our firm grows, so does the collective impact that we can have. So by the way, for some of you who don't give regularly, that's fine too. We'll still work with you. We'd be honored to just sit down and try to help you. But if you're interested in this kind of a process and you want to become one of our clients, or at least learn more about becoming one of our clients, reach out to us online at bnwealth.com or call our office at 847-780-2980.
All right, now let's talk about taxes, saving taxes, specifically what we call tax gain harvesting. And one opportunity that investors should never pass up is the ability to convert taxable long-term capital gains into tax-free basis without paying taxes to do so. What? Here's how it works. This is known as harvesting long-term capital gains. And it's a process of intentionally selling an investment with a taxable long-term capital gain in years whenever, due to your income, that gain may not be taxed. And then if you want to keep the investments, you can actually buy them right back immediately. And the income sweet spot to make this work is this. The gain won't be taxed when it occurs in a year where the investor is in the 0% long-term capital gains tax bracket, which for 2025 occurs when they have taxable incomes of $48,350 or less for single filers, or if you're married, $96,700 for married couples.
Yeah, the genius of doing this is that it actually increases the value of the investment that shows as the original amount invested. This is known in our industry as cost basis. What you purchased it for is typically what that is. That cost basis is always tax-free, and you're able to raise that by the amount of the realized capital gain that was taxed at 0%. So remember, because the cost basis in an investment is tax free, the higher your cost basis, the less capital gains tax you'll have, at a later stage when you really want to sell that investment. And especially beneficial if you end up in a higher tax bracket later. So, and many people do actually end up getting in higher tax brackets in the future. Either it's from, let's say you're working and you get pay raises or bonuses, or if you're retired, maybe you have Social Security kicking in, or it gets higher. You have a pension benefit after a certain retirement age, or you've got those wonderful required distributions that start at 73 now.
No doubt. And even if your taxable income is normally too high to harvest gains with a 0% tax rate, there may be some years where it may fall to a point where you can take advantage of this strategy. And some years where you have lower income, like maybe you're temporarily unemployed or you're self-employed and your income varies from year to year, or between the ages of 60 and 73 and you're retired, because those years tend to be before you start taking either Social Security if you've been deferring it, or until your required minimum distributions start kicking in at 73.
Yeah, and there's ways you can sometimes intentionally create a low tax year that qualifies for this gain harvesting. I've done this for a client where we delayed a bonus until the next year, or maybe you wait to take taxable distributions out of your retirement account until you're required to do so at age 73, or sometimes even later if you're still working and the money's in a 401k at the firm you're still working with or the company you're still working with. You may be able to delay your Social Security benefits until age 70, creating these opportunities. So let me just give you an example how this might work. So, for a simple example, let's just say you're married, you just retired, and your taxable income for the year is going to be $50,000. And remember, for a married couple filing joint, the first $96,700 of taxable income land you in that 0% long term capital gains tax rate. So in this example, you have about $46,700 of this long term capital gains that you can trigger without going over that threshold and still capture these gains tax free.
It's amazing. And if you own stocks or mutual funds in a taxable account, and some of your positions have unrealized long-term capital gains, you have a tax planning opportunity here. So in our example, you can sell enough of your investments to trigger this $46,700 of long-term capital gains. And like you mentioned earlier, Matt, pay zero income tax on it. And assuming you want to keep those investments, you could simply literally just buy them right back immediately, and the 46,700 worth of these taxable long-term capital gains will be eliminated forever with no taxes when you go sell the investments later. And what's neat is you don't have to wait 31 days to buy the investments back to abide what is known as the wash sale rule, because that only applies to taking capital losses, not capital gains. And the next capital gains bracket, by the way, after zero is 15%. So in our example, if this client were to pay 15% tax on that $46,700 of gains, that would amount to a little over $7,000 in taxes. So that is what is potentially saved in our example with this strategy. And imagine if this couple repeats this strategy each year for a period of time. Very powerful.
Yeah, and you never know when this may even go away. There's been talks in the past that they're going to take this feature away. So
Great point.
you don't want to miss years where this is an opportunity. So again, I want to bring up a few things to watch out for. It sounds so great. Let's do this. But, before you do this strategy, you don't want to make sure to see if you have any like potential, what we call capital gain distributions that might pay out, like if you hold mutual funds in those taxable accounts. So mutual funds have this tricky little thing where they'll do these capital gain distributions usually in the fall, typically late in the fall. And we've seen some as late as mid December by the time they pay these distributions out. And these are gains that can be triggered even if you haven't personally sold any of the mutual funds. You need to understand what these gains, capital gain distributions, are going to be before you decide to intentionally realize additional gains. Otherwise, you might actually end up throwing yourself into a higher long term capital gain tax bracket, which is at least 15%, and you end up paying a lot of tax you weren't planning on.
By the way, that's another reason we're not really big on mutual funds. And we were talking earlier about people getting upset. Some of the times I've seen people get the most upset is if the market's down and their investments are down and they didn't sell anything, but the mutual funds themselves had gains in it. So they're taxed in a year where their account goes down, and people get really mad about that.
It happens almost every year that there's a big downturn because the mutual
doubt.
fund managers definitely sell some stuff at that time.
Also, remember, capital gains taxed in this 0% tax bracket are still income and will therefore increase your adjusted gross income, which could potentially increase your taxes in other areas. For example, your AGI, it could result, if that goes up too high, in reducing or disallowing certain medical expense deductions, or if you itemize, or it could trigger the taxation of otherwise non-taxable Social Security benefits, Medicare premiums, things like that. While you have to do your homework to avoid some of these tax landmines, the fact remains that strategically harvesting gains in low-income tax shares may reduce your future tax liability and put a whole lot more money in your pocket.
Yeah, you need to do this appropriately because you also need to evaluate if you have low enough income, if it makes sense to do Roth conversions rather than
Sure.
gain harvesting. And that's why you need to work with a financial planner like us who understands these concepts and help you take advantage of them. You need to work with a financial planner like us who look at tax returns and understand the implications that they're going to have on your finances and making a proactive approach for these tax reduction strategies. And a lot of these strategies need to be done by year end. So if you're in need of a financial planner, or frankly, maybe you don't like your current one and they're not doing any of this for you, we'd be honored if you looked our way. If our financial planning and investment philosophy resonates with you and you're looking to have your money managed by somebody like us, come in for a complimentary consultation. We'll look at everything for you and hopefully we can help you. To explore becoming a client, reach out online at bnwealth.com or call our office at 847 780 2980.